Most people believe investing is about intelligence. They assume success belongs to those with superior math, faster information, or more complex systems. That belief is comforting because it suggests failure comes from not knowing enough. But after watching markets for decades, I can tell you the truth is much simpler and far less flattering. Investing is not a test of intelligence. It is a test of behavior. The market does not reward brilliance nearly as much as it rewards discipline. Some of the smartest people I have ever known produced disappointing results because they could not control their emotions. Meanwhile, others with no formal training did remarkably well simply by remaining patient, rational, and calm when it mattered most. The difference was not knowledge, it was temperament. Markets move because people move. Fear and greed travel faster than facts. Prices fluctuate not because businesses change every day, but because human emotions do. If you expect markets to behave calmly, you will be surprised often. If you prepare for volatility instead of fearing it, you gain an advantage most people never develop. In 1987, the stock market fell more than 20% in a single day. Businesses did not suddenly lose their ability to earn money. Customers did not disappear overnight. Factories did not stop operating. What changed was emotion. Panic replaced judgment. That single day made one thing clear. In the short run, markets reflect mood, not reality. The same pattern has repeated itself again and again. In the early 1970s, investors believed inflation would permanently destroy returns. During the technology bubble, they believed profits no longer mattered. In the financial crisis, they believed the entire system was broken. Each time, fear convinced people that the future had fundamentally changed. Each time, urgency replaced reason. And each time, those who focused on fundamentals rather than headlines were rewarded over time. This is why volatility is not risk. Volatility is simply movement. Risk comes from owning things you do not understand, using leverage you cannot control, or putting yourself in situations where fear forces bad decisions. If price fluctuations alone frighten you, stocks are not your problem. Your expectations are. One of the most useful ways to think about the market is as a partner, not a guide. This partner shows up every day offering prices. Some days those prices are absurdly high. Other days they are absurdly low. His job is not to instruct you. His job is to serve you. The mistake most people make is letting his mood dictate their own. When prices rise, people feel confident. They believe they are intelligent. When prices fall, they feel afraid. They question every decision they have made. That emotional inversion guarantees poor results. Rising prices usually mean lower future returns. Falling prices usually mean higher future returns. But human psychology pushes people to buy when comfort is highest and sell when fear is strongest. During periods of market stress, investors often say they are reducing risk by selling. In reality, they are reducing discomfort. That distinction matters. Emotional relief is not the same thing as financial wisdom. Selling because something feels bad is rarely a rational act. It is an attempt to escape anxiety. The financial crisis of 2008 offers a clear example. Strong businesses with durable earnings, global brands, and solid balance sheets were priced as if they were permanently impaired. Fear dominated decision-making. Predictions of collapse were everywhere. Yet those businesses continued operating, continued earning, and continued compounding value. The only thing that truly changed was ownership. That period created a massive transfer of wealth. Shares moved from investors who could not tolerate uncertainty to those who could. That transfer happens in every major downturn. Wealth does not move from the unlucky to the lucky. It moves from the impatient to the patient. Time is a powerful force in investing, but only if you allow it to work. Compounding does not reward activity. It rewards consistency. Every time you interrupt compounding because you are frightened, impatient, or bored, you reset progress against yourself. You turn time from an ally into an enemy. Many investors underestimate how damaging unnecessary action can be. Doing something feels productive. Waiting feels passive. But in investing, unnecessary action is often harmful. The best decision is frequently to do nothing and let time work. This is difficult because inactivity provides no immediate feedback. There is no sense of accomplishment. But over long periods, it produces extraordinary results. If you feel compelled to act because prices are moving, that is a warning sign. Markets exist to serve your long-term interests, not your short-term emotions. If you rely on constant activity to feel in control, you are more likely to sabotage yourself. A useful question to ask before making any investment is simple. Would I be comfortable owning this business if the market were closed for several years? If the answer is no, you are relying on liquidity rather than fundamentals. That reliance becomes dangerous precisely when you want liquidity the most. Another common mistake is believing you must always be invested in whatever is most exciting. People chase what is popular. They compare themselves to others. They feel pressure to keep up. That pressure leads to poor decisions. Investing is not a competition. There is no scoreboard. There is only the long-term outcome of your behavior. You do not need to swing at every opportunity. Opportunities appear often enough if you are prepared. The key is having the discipline to wait until the odds are clearly in your favor. Saying no is often more important than saying yes. Avoiding mistakes matters more than capturing every gain. The market will constantly test your temperament. It will test your patience during long periods of boredom. It will test your courage during sharp declines. It will test your discipline when others appear to be getting rich faster than you. These tests never stop. Passing them consistently is what produces durable success. Short-term success achieved through poor behavior is dangerous. It reinforces habits that eventually fail. Speculation can work temporarily, but it is unreliable. Discipline may look boring, but it is dependable. The market does not forgive repeated emotional mistakes. One of the great advantages individual investors have is the ability to design their environment. You can reduce how often you check prices. You can avoid leverage. You can invest only in businesses you truly understand. You can structure your life so that market movements do not dictate your mood. These choices reduce emotional pressure and improve decision-making. Temperament is not something you are born with or without. It can be trained, it can be protected. The successful investor is not the one who never feels fear, but the one who does not act on it. Fear itself is not the problem. Acting on fear is. Periods of uncertainty are uncomfortable, but they are also necessary. They create the conditions for future returns. Periods of calm feel safe, but they often hide risk. Understanding this cycle allows you to behave rationally when others cannot. If you want to improve your results, stop trying to predict markets. Start trying to understand businesses. Stop watching prices. Start thinking in years instead of days. And stop measuring success by how exciting your decisions feel. Excitement is rarely a good sign. The market does not require brilliance. It requires endurance. You do not need to outsmart others. You need to outlast them. Over time, that difference compounds into extraordinary results. In the end, investing is not about beating the market. It is about avoiding self-sabotage. The market offers returns to anyone willing to behave sensibly over long periods. The difficulty lies in maintaining that behavior when emotions are amplified. The market is a device for transferring wealth from the impatient to the patient. That has always been true. It will remain true. And those who understand it do not need to predict the future. They simply need to remain rational when others cannot.